Hello, this is Josh Warburg with Great River Financial, and this is the 2024 update, or what we like to call What in the World Happened. Markets around the world were volatile in the fourth quarter of 2024. While U.S. stocks and global bonds were up in the fourth quarter, international stocks, global real estate, and U.S. bonds were all down in the fourth quarter of 2024. When we zoom out and look at the full year of 2024, you'll see that markets were up across the board, including the US stock market being almost 24% and global bonds being about 5%, which are both kind of at or above their long-term averages. And international stocks, global real estate, and US bond market being below their long-term averages, but still above zero for 2024. So all in all, 2024 was a pretty good year for markets in the US and around the world. When we look at 2025 year to date, US and non-US stocks and bonds are up across the board. Now, it doesn't necessarily feel this way to most investors, and a lot of that is how we get information from media. Media tends to focus on negative news. That's true not just of financial news, but any news across the board. And they tend to focus a lot more on negative days than the next day when the markets rebound. So even in a year where international stocks are up almost 7% in less than 2 months in 2025, it certainly doesn't feel like that to many investors. So that's what has happened over the last year in markets. What do we expect to happen going forward? Now, it's really difficult, I would say impossible, to project what's going to happen in any individual year in markets. But over a longer period of time, 10 plus years, it's a lot more reasonable to have an expectation of a range of average returns in major investment classes. This is Vanguard's 10-year average return projections for major asset classes around the world. Now, what they're expecting, because US stocks have done so much above average the last 10 years, is that the next 10 years they'll be slightly below average, so anywhere from 3 to 5%. Whereas US bonds, they expect somewhere between 4 and 5%, with about a third as much volatility. So actually bonds to have a slightly higher average expected return than US stocks. Now, when we look at US value or US small cap stocks, where the index funds that we use tend to have more than the index it does itself, they expect those to do a little bit better than US stocks on average. In international stocks, they expect somewhere between 7 to 9% the next 10 years on average, which is a lot closer to its long-term averages. And then US inflation somewhere between 2 and 3%, which is closer to its long-term returns. Now, one thing I'll say about an average return over a long period of time is when we say an average return is between 3 and 5%, what most people hear is that it's going to be between 3 and 5% most individual years. But how it really works is more like the average temperature here in Minneapolis year-round is 48 degrees. But it's almost never 48. It's way hotter in the summer, way colder in the winter. And markets aren't as predictable as season temperatures. So when we think about an average return between 3 and 5%, there's going to be some years that it's probably above 20% and some years where it's down 20%. And it's virtually impossible to predict between those two. But we expect US stocks to do slightly worse the next 10 years than they did the last 10 years, but still positive and above inflation. And bonds and international stocks to do better than they have the last 10 years. Based on those 10-year expected returns, you may wonder, should you change your investments? And it really depends on your own financial plan and when you're planning to use the money, when you plan to retire. So in this hypothetical case, which is true for most of our clients, they tend to have a high percentage of stocks when they're 20 years away from retirement, and then slowly over time, lower how much they have in stocks and increase how much they have in bonds until they're somewhere between 40 and 60% in stocks at retirement age. And in this plan, if somebody, say, if this hypothetical client, say 14, 15 years away from retirement, and maybe they're at 100% or 90% in stocks, given where stock prices are relatively high compared to historical averages, and interest rates being much higher than they've been in the past, it may make sense for this client, rather than waiting until they're 10 years out, is kind of sooner rather than later moving from 90 to 80% because it fits within their plan. Now, the plan wouldn't be to move from 90% to 80%, and then if and when stock prices go down, to go back to 90%. It's that you would make the next step down this ladder sooner rather than later. And this is something we're going to be talking to clients a lot about in 2025 is, does it make sense to ratchet down 1 or 2 levels of stocks as we get closer to retirement? Maybe your situation has changed. Maybe you're closer to retirement than you thought. Maybe it makes sense to move one leg down. If it's something you want to talk about before our annual review, schedule some time with us. We'd love to chat. Some key takeaways. Stocks and bonds were both up in 2024 and so far in 2025. Even though markets tend to overreact to noise and there may be higher volatility going forward, we expect US stocks and bonds to have positive returns over the next 10 years, even though those returns might be very similar to one another. And we also expect that international stocks, because of their low prices, may have higher than average returns the next 10 years. It's always important to stay diversified and have an investment mix that supports your plan in any market environment. And you may want to lower your stock percentage as you approach retirement. As always, if you have questions, feel free to shoot us a call, schedule a time with us, send us an email. We'd love to chat with you. I'm Josh Wolberg with Great River Financial. Stay curious, my friends.